Hi, everybody. It's Leslie with the New Mexico Small Business Development Center, and I'm pleased to announce that we have a new webinar that we've just added to our mix. I have Tommy Thompson here with me today. He is a SCORE counselor who specializes in business and corporate financial planning, also business valuation. His 40-year career includes experience in international consulting, manufacturing, software, and high-tech hardware. Tommy earned a bachelor's degree from Hamilton College of Clinton, New York, and an MBA from Rutgers University. He's a licensed CPA, now retired in New Mexico and New York, and was formerly accredited in business valuation by the American Institute of CPAs. In retirement, one of Tommy's key business interests is as a voiceover actor and announcer, which sounds a lot of fun. I also want to remind everyone that the New Mexico Small Business Development Center is strongly encouraging all New Mexico small businesses to learn about cybersecurity risk and make sure they're taking actions to protect their data and small business, especially from ransomware. Put your questions into the Q&A and we'll pick them up throughout the entire webinar. Tommy, turning it over to you.
Thank you very much, Leslie. Good morning, everyone. As soon as my slides start to move, which they were doing a minute ago, we'll get going here. Okay, I'm going to stop the share for just a second and say good morning and then try and fix the slides here. I'll be right back. Slideshow. Okay, and share the screen. For some reason, they didn't want to run. There they are. Good morning, everyone. Now that we have the technicalities out of the way, welcome to Cash is King, cash management for your small business. Today, we wanted to, Leslie's already given you a very good introduction of what I've done. My basic interests have been general management and financial management and planning for small businesses throughout my career, whether I was in a consulting setting or in a corporate setting, and I've been in several. We'd like you to follow some quick guidance for the presentation. First of all, we've already muted your audio stuff, and those of you who are maybe here on the phone, we'll unmute you at the end to see if you have any questions for us. Set your zoom ratio to fit window if you want to see the screen in its largest and best manner. We'll be using, as Leslie said, the Q&A function to take some questions. When you write down your question for us, if you just include the related slide number, we thank you very much for that. Today, what we're going to talk about is what you can get out of SBDC for training, offering, and counseling assistance. We're going to talk some about today's training objectives. We're going to talk about our key topic, which is cash flow management and record keeping for many of the COVID-19 pandemic-related relief programs that are out there. We'll take all your questions, and then we'll talk about next steps that you can take for your business in order to adequately address the whole topic of cash flow management. Now, for training and counseling, the nmsbdc.org website for SBDC New Mexico will offer you both a calendar for training offerings for pandemic response, for cybersecurity, for general business topics as well. And also you can go there to request no-cost business counseling and loan application assistance from SBDC specialists. So the sbdc.org, nmsbdc.org website is the one you really want to be tuning in on for further training, offering, and counseling assistance. Now, today, what are we going to talk about? First of all, we're going to talk about what is cash flow. There's a lot of different definitions by different people from different places. I've got one that we're going to talk from, and we'll see how it works out. Second, what makes cash flow through your business? What comes in? What goes out? Why does it come in? Why does it go out? And we're going to talk about some strategic principles that if you keep top of mind, you'll be able to use to keep on top of your cash flow. We're going to talk about forecasting cash flow because that's an absolutely vital tool to you to help keep your business running with cash. Cash is the lubricant of business. It's that stock of stuff that helps us pay for things as they're due and helps us get money from our customers. Forecasting it, having an idea of where you'll be in 4 months, 6 months, a year is very important so that you can communicate properly with all the stakeholders in your business about what you expect cash to be doing in your business in the future. Then, as well as forecasting it, we're going to talk about the tactics of cash flow management, the specific things that you do to keep cash coming in on time or even quicker, and to keep it from going out except on time or even slower. And then finally, we've got a few words to say about record keeping for pandemic relief programs that are out there. The commonest one, the PPP, the Payroll Protection Program, offers you free cash money. How do you like that? Free cash money if you spend that money the right way in the first place. And we're going to talk a little bit about what some of those kinds of records are. Now, one thing that everybody has to remember right off the bat is that cash is king in your business. It's what lubricates the business flow coming and going. It's what keeps you in business and open for business. When you run out of cash, everything stops and you crash. So be aware of that. Cash and cash flow management need to be at the very top of your mind. Now, what is cash flow? Yogi Berra had a definition, and they pay in cash, which is just as good as money. And a little more fundamental definition is that Investopedia calls cash flow the net amount of cash and cash equivalents. That's stuff that you can turn cash into really quickly, that are transferred into and out of a business. The company's ability to create value for shareholders is determined by its ability to maximize its long-term free cash flow. Oops, there's a new word, free. I know we all like that word, right? Free cash flow is the cash that's available to stakeholders and investors after all the business's needs have been taken care of, after all its expenses have been taken care of, after all its debts have been paid in the proper order, in the proper time, after all its capital expenditures have been taken care of. The cash that's left over, generated by the business, is what determines its value in the long run. And so that's another reason that you ought to consider cash and cash flow as one of the key things in your business. Now, what makes cash flow? First of all, it's cash money coming in. Cash sales. If you have a counter in the front of your business, people come in and put cash down on the counter. That is cash in. That's cash flow in. Similarly, if you sell on credit, it's not the sale on credit that creates the cash flow, is it? Because you've just given somebody goods or services against their promise to pay you later, not right now. Similarly, if somebody comes in and says, I want to get this stuff from you next month, and you say, well, that's a special order, I'll have to have a deposit, then the deposit is cash now, it's cash coming in. Similarly, if somebody says, I'll pay you in advance for a year's worth of lawn service, that prepayment is cash now, it's cash coming in. Here in pandemic times, which fortunately we have the end in sight of, although there's still some issues, pandemic relief loans and grants are available from a variety of sources, including the federal government and the state of New Mexico. The PPP, the Payroll Protection Program, the EIDL, the Economic Injury Disaster Loans, the state's grants to small businesses and owners, the Shuttered Venue Operators Grant Program, SVOG, for people who own nightclubs and stuff like that. Also, those all provide cash at the moment that they're funded, although you do have to apply in advance. Bank loans, owner loans from yourself, from your own pocket, loans obtained from family and friends that you've got to pay back another time. All that is cash money coming into the business. That's cash flowing in. Now, it'd be nice if it flowed in and didn't flow out, but unfortunately, it does have to, because you have cash going out, first of all, for all your employees' compensation, for their employee benefits, and for the taxes you withheld from their pay and the taxes you owe based on the payrolls. You've got payments against accounts payable, where somebody gave you goods and services in return for your promise to pay later. Rent, that pesky landlord wants to get paid every month. And the operating expenses it takes to keep your business going. Those are all things that flow out of the business. All right. Similarly, outside of the income statement, cash comes and goes from your business from things that aren't part of your profitability. First of all, when you repay a bank loan, the interest part of that may be part of your profitability, but the principal portion isn't. Capital equipment purchases, stuff that will last in use for more than a year. Big machinery, equipment, cars, trucks, all those sorts of things don't immediately impact your profitability statement, but they do impact your cash flow because they go out. Similarly, when you as the owner draw money out of the business, whether that's for compensation or whether you call it just an owner draw, distribution of profits, that's cash out of the business. Repaying loans to family and friends. Uncle Morty needs his money repaid. That's cash going out. Now, cash flow is different from profitability because there's more sources of cash. Notice how I said bank loans, owner loans, pandemic relief loans and grants. Those things aren't necessarily part of your operating profitability. Similarly, there's more uses of cash than show up in your profit statement. As I just said, bank loan repayments, the principal part of them, capital equipment, dividends to shareholders, loan repayments to family and friends. All those things are cash movement, but they're not part of your profitability. And it's important to distinguish between the two. Your CPA will help you figure out what you made on an accounting basis, and he or she has the ability to figure out what you're making and what your cash flow is and how that's different from your profitability. Now, what isn't part of cash flow? If you put goods across your counter and the customer says, okay, I'll send you a check next month, and you've approved that, that's a sale on credit. Did any cash change hands? No. You bought the goods earlier, all right, and you presumably have a different timing for paying for the goods. Your customer's going to pay you later, and so that's a different timing. So you don't have cash on the counter. So credit sales are not cash flow. The same way works with your vendors. Your purchases on credit from your vendors, the stuff that makes accounts payable, that's not cash flow either, because no cash moved when the goods came in, right? So it's important to recognize it's cash money on the barrelhead that determines what your cash flow is. Now, if there's any questions about that, please jot them down and we'll address them in due course. Strategy for cash flow. It's fairly simple. If you don't work at it, it doesn't happen. If you don't forecast it, you don't know it's going to happen. If you don't track it, you don't know it while it's happening. And if you don't pay attention to accelerating the cash coming in and slowing down the cash going out, you're simply going to have less cash to work with. So the basic cash flow strategy is to have it in the top of your mind, right up there along with increasing sales to customers, right along with finding new customers, right along with finding reliable vendors. Cash flow needs to be in the top of your mind. Now, when we forecast cash flow, we need it in order to tell the story. We will have to talk to stakeholders about cash flow, especially if it's those stakeholders that we owe cash to that we want to slow down cash going to. We need to understand what our cash flow is forecast to be so we can tell an effective story when we ask for forbearance from vendors and creditors, okay? We need to track it while it happens. First of all, tracking it tells us, did we make the right assumptions when we forecast what was going to happen? Is it working out the way we thought it would? By the way, it won't, but you need to track in order to know why it's not working out the way you forecast it. There are differences between what you'll assume and what actually happens, and you want to be able to compare the forecast and the actual to understand not just how much it differs by and how that affects your next forecast. Remember, this is not a one-time deal, but also how it affects the cash you have on hand and how you're going to talk to stakeholders about whether or not to slow them down. Then tactically, you have to do things. You have to talk to people to accelerate the cash in. You want to talk to a customer about, do you want to subscribe to my service for 6 months or a year? I'll give you a month, or I'll give you a month early, a month additional service for that time. Or do I need to talk to the bank and say, here's what's happening. My cash flow forecast says I'm going to be short this month. Can we negotiate a change in payments so I pay you double in 2 months or 3 months? All right. The cash flow forecast and the tracking against that cash flow forecast gives you the information to tell your story. And you have to tell your story so that everybody understands that you, as a business, have a strategy to manage cash flow, that you're working at it, and that you're on top of your business. This gives confidence to the people you owe money to. Your creditors and your bankers and so forth will be impressed that you're paying attention to cash flow, that you're forecasting it, that you're tracking it, that you're communicating with them, most importantly, before something suddenly happens that they weren't prepared for. All right. And that's why this basic strategy is so important in your business. Now, when we forecast cash, what do? First of all, you got to know, what's my cash in the bank right now? Okay. What is it right now? Now, if we do this month by month, it's what's my cash in the bank at the end of the month. Then we got to say, okay, what do I expect to come in the next forecast period? Why is it coming in and when? Now, some businesses do this week by week even. I was in a business in the 80s once where the marketing organization forecast our order flow. And they forecast it day by day by day, week by week, within months, so that they would know almost immediately if a marketing campaign that they were conducting was working or not. And they would measure days from the marketing campaign's drop date. This happened to be in the 80s, of course, it was direct marketing, direct mail. And they knew the date they dropped the campaign in the mail, and they knew from prior experience what they expected to happen by way of orders, how long after the mail dropped. All right. And so they knew that was supposed to be coming in certain days, and they knew why it was supposed to be coming in. It was that campaign. Now, similarly, your business, whatever it is, needs to understand, what do I expect to have coming in? If I sell on credit, or if you sell on credit, the goods go out on a date. You set a date 30, 31, 42, whatever days later when you expect your customer to have paid you. And that's part of your forecast. Now, you can do that collectively for all customers, just because you can forecast as a group when the majority of your customers are going to pay. In many businesses, 85 or 90% of your customers will pay within the 30 days that you gave them to pay. 4 or 5% will pay 60 days. 2 or 3% will pay 90 days. And 1 or 2% will go out the door and never come in. And they'll never pay. So you can understand that. You can set that up in a model for cash flow forecasting to understand when you expect this month's sales to get paid. And you just build that month by month throughout your forecast. Similarly, you have to forecast what's going out. Why is it going out? When's it going out? If you have employees, you know what your payroll is. Even if you're the only employee, you know how much you're taking out of the business each month to pay the mortgage and buy groceries. What's going out? Who's it going out to? Why is it going out to them? And when is it going out? Same kind of thing. By doing that, by thinking about that, you now have information that you can put down on paper and come up with a forecast, because at the end of this process, what you have now, plus what's coming in, less what's going out, forecasts what your cash is going to be at the end of the period that you're forecasting. Now, for periods, we're going to use just months as an example. But as I say, businesses with critical functions happening and patterns of past experience can forecast day by day and week by week if you want to, if it's that critical to your business. Normally, I say to people, my clients at SCORE and others, is forecast month by month for a year out, 12 months. Then forecast by quarters for the next year. That's for business planning. For cash management and cash forecasting, the next 12 months are really your critical period, and the next 6 months are even more critical than that. So when you build a cash flow forecast, you build it for a 12-month period and then update it every month. If you don't update it, it's out of date the first day you put it down on paper. By the end of a month, how far out of date is it? Unless you renew that forecast. You use the prior experience of what you were finding out, what was different than what you had forecast. You use that experience to change your next forecast. So that when you change the forecast, you're now working from recent first experience that helps you be more accurate in that next month, 2, 3 period. All right. Forecasting is critical because it provides 2 things. One is information to you to plan for, and second is confidence to your creditors, because you can say, I'm forecasting my cash flow and it tells me this. Work with me here. Right? And they'll say, oh, he's paying attention. Right? Now, this is an example of a template for forecasting your own cash flow. This is not only, the template is not only provided in the copy of slides that you should have received before the webinar, it's also provided in a separate document that should have been sent out too. That document is an Excel spreadsheet that has this all live in it. And all you do is you replace these numbers with your own numbers. Now, the first section here, and I've only included the first 6 months so that you can actually see it on your screen. The first section here, section 1, looks a lot like an income statement. You've got revenue from sales. You've got cost of goods sold expenses. You've got the operating expenses of the business. And then you've got a funny looking line here. It's labeled EBITDA. What is that? That's earnings before interest, taxes, depreciation, and amortization. We'll account for all of those. We'll account for the interest and the taxes later on. But depreciation and amortization are accounting conventions. They're accounting tricks that account for the cost of capital expenditures that don't normally get reflected in the operating profit and loss. We'll see that in the next schedules. Now, this comes down, this EBITDA number is often used by corporate analysts and others as a proxy for actual cash flow. And it gives you, within a month, the accounting determination of what your approximate cash flow is going to be, but not necessarily the timing of that cash flow. To do that, we have to continue on in our forecast. And the next slide here talks about 2 other sections of the forecast. Remember, I talked about not accounting for interest in the operating EBITDA? Well, here we account for interest because now in this section of debt service with principal and interest, we account for the cash that's paid out to service both the debt principal, the principal payments, and the debt interest. Remember, it's cash, so we don't care what it's for. It's going out of the business. So it's all debt service cash going out of the business. In section 3, we account for capital expenditures, things we're going to buy to use in the business that last more than a year. That's the accounting convention. And these don't go into our profit and loss statement because we're going to use depreciation to account for them over the time that they're useful to us. But the cash moves today. It goes out of the business today. So this is the cash moving on account of capital expenditures. Finally, we reconcile all this together because we put in and take out other cash flow items and the so-called timing differences between recognizing a piece of revenue or a piece of expense as an expense and recognizing the cash movement instead. For example, up at the top here of section 4, we add back the cost of goods sold which is an accounting determination of cost of sales. And we take out the actual cash that moved out of the business on account of those items. It's inventory purchases. If we're in a manufacturing business, it's manufacturing overhead costs that we paid out in cash each month. Employee salaries, direct labor that we paid out each month, and the tax payments that are associated with that. So that we've replaced the accounting determination with the cash determination of the inventory effect. Similarly, we go up to our sales line. Now, we made those sales, we made some of them on credit. So we're going to deduct and take out all those sales from our cash flow. But what we're going to add back in is the money we collected this month from cash sales and people paying us for transactions that happened last month or previously. All right. It's the cash coming in that we're focused on. Similarly, here, we take care of the taxes aspect by recording when the tax cash went out, not when our accountant accrued it for profitability purposes. You guys already follow that? Your accountant or you might accrue taxes based on your monthly operating income, but the actual estimated tax payments take place differently. And this is how we do that. This is how we account for those, how we include them in our cash forecast. Similarly, changes in accounts payable is a key factor, because if my accounts payable goes down at the end of the month, I've actually paid out cash to reduce that liability, right? Because if you think of it collectively, accounts payable is just one big liability. If we reduce it, we've paid cash out. If it goes up, that means people gave us more credit than we paid them for, and therefore we've got cash in the business. All right. Then I've got a couple other lines in there that you can use for anything else that pops up that you think applies to your business. The total of that section 4 is then netted against our EBITDA from the last slide. Remember the EBITDA down here at the bottom of the last slide? That is netted with the net cash flow, or excuse me, the total in section 4, and that gives us a net cash flow number. All right. That's the cash that we generated for that month. Now, that number plus the cash that you started the front of the month with gives you the ending cash balance here at the end, down over here. And you'll notice the 10,905. If I go back up 2 slides, my beginning cash in January was $10. My ending cash balance we just saw is 10,905, and that is what we start February off with, 10,905. All right, and you see how this follows from month to month to month to month, all the way through your forecast. That's how the cash flow forecast flows, so to speak. Now, a batch of businesses often will set a minimum cash balance target. Any individual business may set a different cash balance target for itself. Your business, you should set a cash balance target for yourself. And this is the amount of cash that you feel comfortable holding on to, that you are confident will cover your needs for the next piece of the period. All right. Depending on volume. Sure.
I hate to interrupt because this is very valuable information, but I want to address a question that we had in a chat. And one of our attendees said that they did not receive the slides via email prior to the class. Can we please get a copy of them sent to me? I wanted to assure everyone, because again, this is a lot of technical information, very important. I will be sending out a follow-up email with the slides attached. Also, I want to let everyone know that Tommy, this is his first one. He will be doing this webinar a couple of different times, once a week. So any questions, once you receive the slides, you want to revisit or have any questions, please feel free to either get the pre-recorded version or come back with your questions. We want to make sure everyone has the information that they need.
Leslie, thank you very much. As I was saying, once you've set a cash flow target for your business, some people just do it as simply as saying, okay, I want a minimum of 1 month's expenses, 1 month cash out, I want a minimum of that in the bank at all times, just in case there's a big hiccup and you don't get any money next month. That's one way to set it. Another way to set it is to analyze your business cycle over the course of a year and say, okay, in December or January, I don't need very much money because I'm not at a very high place. Whereas out in May and June, I do need a lot of money because I'm spending a lot then in order to support the business I'm going to do in the fall and the winter. So once you set that number, then you can calculate what your cash excess or shortfall is going to be. In this case, if we set an $8,000 minimum cash balance target, and we actually have $10,905 at the end of the month, we are $2,900 to the good. Hooray! Let's all go out for a 3-martini lunch, right? In point of fact, many businesses will stockpile their cash because they know they're going to need more later in the forecast period. And you use that forecast to understand when you're going to be needing the money. Now, not every business is as nice as this one, where you've got regular, nice, big cash surpluses every month. Some businesses go up and down every month, and they just need to have more cash on hand certain times than others. That's why building up a cash excess early in the year will help you later on. Again, going back to the example of the manufacturing company I worked for in the 1980s, we sold and shipped most of our products between March and June of each year. It was a lawn garden related product. If any of you heard of the Troy-Bilt rototiller, you'll know what I'm talking about. And that was bought by people who were going to plant gardens. So starting in the south in late February and continuing on up to the north at the end of May and early June, we would ship most of our product and get most of our cash in the door. During those months, cash would start coming in with orders in late January and early mid-February, and it would flood in throughout the spring. And then we would live off that cash because after the spring and a little bump in the fall as people mulch their gardens, we wouldn't get much more cash coming in. And come December, our treasurer would be putting out a daily report that said, here's how much cash we have in the bank, folks. Be careful with it. And then come January, the flood would start rising again, just like the spring floods. So that's what to keep in mind. Now, having this in front of you, you can tell your story to the stakeholders. You can tell the bankers, oh yes, we've been forecasting our cash. We'll have no problem keeping up with you. In fact, we might even be thinking of expanding and needing to change our loan relationship a little bit. And the bankers will be impressed because you've been paying attention to what's going on. Now, after you forecast your cash flow, you got to track it. Why do you track it? You track it to find out if what you thought was going to happen actually did. And if it didn't, how do you adjust for it? Now, if it's better than forecast, that's wonderful. That's a great problem to have. If it's not, if the better than forecast this month means a lot worse than forecast 2 or 3 months down the road, now you've got an early warning of that and you can take steps. Now, all the major accounting software lets you create a P&L statement. It lets you create a balance sheet. And from those and the activity that you put into it, it will create a cash flow statement. I tell everybody track it by month. Depending on the kind of business, you might not bother to track it except quarter by quarter if you've got a real stable business. But in an emergency like the pandemic, when everything suddenly disappears, now it's time to start thinking about tracking it faster than month by month. Again, all the major accounting software will let you pull weekly P&L statements or daily P&L statements based on what you've entered into the system. Okay. And so you could track your cash flow against your forecast by day or by week. Some people do it by week and just roughly say, okay, 25% of the month should be the week. All right. And that's easy enough to do. You can also go to the formal course of creating your cash flow forecast and creating that forecast on a weekly basis. Same format, same way, same inputs, except now you're doing it week by week and not month by month. All right. When you can track it day by day, you get earlier warning, or week by week, you get an earlier warning of how the month is looking. You get an earlier warning of how the future is looking. You get an earlier look at what could be. Okay. The ghost of Christmas future, so to speak. And that helps you by giving you warning time to start reacting, by start doing tactical things to speed up the cash coming in or slow down the cash going out. All right. But tracking it is the second great virtue next to forecasting it. Now, cash flow in. If your strategy is to pay attention to cash flow, then accelerating your cash flow in, the acceleration tools you need are some of these. First of all, go out and sell, sell, sell. Look at your existing customers. Don't just wait for them to reorder. Look at the customer, look at their purchases, look at their purchase patterns. Call them up, offer more and related products, or offer pricing discounts for fast payment. All right. 1% 10 days might become 2% for 10-day payment, or 3% discount for cash with the order. All right. But anything to get them paying up quickly. Right. Above all, in the inbound side, you have to continue marketing and prospecting. I know it seems odd to continue spending money on marketing and spending money on prospecting new customers when in fact you're not getting orders from them yet. It's your existing customers you want to focus on. But I'll tell you, your existing customers slowly fall away from you. It's called customer base turnover. And if you're not replacing those customers with new ones as quickly as you can and expanding that customer base as quickly as you can, you are going to be having issues down the road with your cash flow. So continue marketing, continue prospecting. I tell that to everybody. Now, I also tell everybody, use only one bank. Now, this may seem obvious if you're a very, very small business, but you'd be surprised at how many businesses that aren't very big actually have 2 or 3 bank accounts, maybe with 2 or 3 banks. You might be using one bank for your basic checking account and another one to process your MasterCard and credit card payments. Well, you might be able to consolidate that into one bank, or a credit card processor that you're paying as a vendor who shuffles all their money right into that bank as soon as it's credited. All right. And then you can also accelerate your cash flow coming in by borrowing. Now, you have to be careful, because if you're borrowing against people who owe you money on credit, you want to make sure that you have a revolving credit line at the bank that allows you to take that credit sale and in effect show the bank that you made that credit sale, and the bank says, okay, you can borrow 70% of that or 80% of that from us. When the customer pays you back and the credit base goes down, the bank will say, okay, you need to pay down your loan base at the moment. That's for things like sales on credit, to support accounts receivable, to support inventory purchases, for example. Other kinds of loans you use to match other things that you're paying for. If you're paying for capital equipment, for example, you might want a term loan with level payments to take care of the obligation you're undertaking when you buy that equipment on credit. All right. And so that's the kind of thing that you want to do for longer term loans, leasehold improvements, adding a production line within the building that you're in, adding on to a building that you own. All of that requires longer term financing, and you really don't want to be paying for it with a revolving loan. So think about the type of loan you need for the type of financing that you're requiring. Now, collect receivables faster. Seems obvious, but a lot of people don't really pay attention to that. They assume their customers will pay them on time. In a panic or a pandemic or a recession, people slow down their receivables payments. It's up to you to stay on top of them to collect those receivables in a timely fashion. You want to ideally be collecting your 30-day receivables no later than the 30th day on the day they're due. Okay. Now, to do that, you need to use professional collection techniques. Education about that is beyond the scope of what I'm talking about today, but some of those techniques include tightening credit requirements. In other words, tightening up how much credit you give to particular customers, especially the ones that are a little slow in paying you. The ones that are slower still in paying you, you might move off of a credit onto give me a credit card with your order status, all right? Or prepay with a company check status. And then for those people you still have credit to, you're going to track their invoices and the balances they owe you, and you're going to call them periodically, more often than you might have before, in order to follow up with them. Say, hi, how's everything going? I see you've been buying nice things well from us. Thank you very much for your business. Just wanted to touch in today and make sure that you were pretty sure you were going to be able to make your payments on time this month. I'm not a collections guy. I don't know the lingo, but those are the kinds of concepts that you want to get across to your customer so that your customer knows, hey, they're keeping an eye on me. I better live up to my side of the agreement and pay them on time. All right. Professional collection techniques will help you more than almost anything else to get cash flow in on time when it's supposed to be there. Now, I mentioned revolving lines of credit. There's another tool for short-term financing that is very expensive, but in an emergency could be, or in a certain kind of industry, could be something that you would use. For example, in factoring, you sell on credit. You take that invoice to your factor firm, and they, in effect, buy the invoice from you. Now, do they give you the face value of the invoice? Oh, no. They give you a discount to the face value of the invoice to account for the time they expect to take to collect it and the amount of money they want to make in the business. They want the amount of return they want on their investment in buying that from you. Okay. This is heavily used in the fashion industry, and much of the factoring industry in the country is centered in New York City, which is the center of the fashion industry for the country generally. And you can see there where you ship your clothing out to stores in July and August and even perhaps earlier for the fall and winter selling season. And you're not going to get paid till the store sells the clothing. That might be 5 or 6 months down the road. Well, what do you do for cash in the meantime? A factor will buy that invoice for effectively 6 months worth of interest plus the money they want to make on it. That might be a discount of as much as 25%. And then they will give you the cash. You have 25% less cash, but you have it now when you need it. Finally, you can also speed up collections a little bit by using a lockbox service if you have enough volume. Lockboxes are services that banks offer where your customer is directed to send a check not to you at your office, but to a post office box. That post office box is collected by the bank every day. The bank processes the checks that they're getting in that mail and credits your account the same night, so that you save between 1 and sometimes 3 or 4 days worth of float time when the money came from your customer, but it hasn't been credited to your account yet. Okay. It's a tool mostly used by somewhat larger businesses, small businesses, unless you have thousands of customers sending you $1 or $2 a piece, which doesn't always happen. Doesn't happen very often anyway. Larger size businesses typically use lockbox type processing. When you send in your MasterCard or Visa payment, for example, you send that to a post office box. That post office box is collected by the processor, whether it's a bank or a private processing firm, and then that's processed that day and collected and credited that night to your account. Okay. Now, the other side of this, which I'm sure some of you are more interested in than the acceleration side coming in, how do you slow down cash going out? It seems to flow like water, or like the floods they had in Belen the other day. But in reality, what you want to do is you want to slow down your accounts payable payments. That's the principal way to slow down your cash going out. You have to pay your employees on time. You have to pay your payroll taxes and your withholdings on time. You can't slow those down. The feds and the state have no sense of humor about not paying withholdings on time. But your vendor list, if you analyze it carefully and you prioritize your vendors as to the most important ones, the ones who are providing you with absolutely vital goods and services, prioritize them for payment. Then you can take the list, you can communicate with each individual vendor, tell the story, tell them why you want to slow them down for 1, 2, 3, 4 months, and how you will catch them up. And you can use your forecasted cash flow. You can say, according to my cash flow forecast, we're going to be short for these 2 months. I'll make it up to you in the 3rd month and fully pay off your invoice, our whole balance that month, and get us back on a level playing field. Tell your story. Don't just stop paying a vendor. They get very nervous when a regular customer who's been paying regularly suddenly stops paying regularly. Communicate with them, tell your story, ask them for this favor, and most of them, will be more than happy. Well, not more than happy, but they'll be happy to work with you for a short period of time. This works for 1, 2, 3 months, 4 sometimes, and then you got to be finding your way out. All right. But communication is critical, because what they'll do if you stop paying them, or you don't pay them what you should be, or your credit goes over their preset limit for you, they'll stop shipping. And if there's somebody you depend on to stay in business by getting regular shipments from, suddenly your business isn't running because they've stopped shipping to you. So you have to analyze the list, prioritize those vendors. Your A group might be the guys you absolutely can't do without, that you actually have to pay. They might include some fairly small vendors. But if those small vendors are selling you things that you absolutely have to be including in your product or including in what you ship to customers, then they've got to be paid. Similarly, your B vendors are the next group, right? They're the people that you could get by without them shipping to you for a day or a week or a month. And finally, your C vendors, they're the guys that you buy from occasionally, only once in a while. Maybe you don't have to pay them anything. Maybe you haven't paid them anything for a year because you haven't owed them anything, because you haven't bought anything from them. But your C vendors are still people that you need to communicate with to tell your story. When you need to tell the story, if you need to buy something from them, you need to communicate with them. You need to ask them and say, I know I've been dealing with you on 30-day credit. Can I have 75 days for this invoice? And I'll pay you on 75 days. That's what my cash flow forecast is telling me I need to do. And blame the cash flow forecast. You created it, but you can blame it. That's another good thing about forecasting. My accountant tells me I can't do it for 75 days. Throw them under the bus. It's what you need to do to make sure that you're managing your cash flow properly. And telling your story is the most important part of it. Now, other things to decelerate cash flow. Cut expenses. That's easy for me to say, right? But even though you think haven't got any opportunities, if you sit down and you analyze your expense ledger carefully, and you analyze your payroll carefully, and each expense going out, what is it for? Why are you making this expense? What does it bring you in the short term? What does it bring you in the long term? Can you do without it for a period of time? All right. Each ledger item needs to be looked at. Each vendor item in that expense category needs to be looked at. Each employee in your payroll needs to be looked at very carefully. Can I do without George for 2 months? Forget he's George. He's material handler too. Can I do without him for a month? That person, him or her, doesn't matter. Analyze it carefully. Payroll changes are some of the most emotionally laden and fraught things that you have to do as part of managing a business. Do them carefully, do them sensitively, do them compassionately, but you do have to look at payroll after a while. Next item is analyze your outsourcing opportunities. You have an in-house bookkeeper and an accountant. Can their functions, and I know it's hard, can their functions be done by an outsourced firm for less? And how much do you save? And how much do you give up in terms of direct day-to-day control and direct day-to-day capability? But you have to analyze all of them. If you are in a business where you do a lot of packing, a lot of assembly of product into a package, is there a packaging outsource opportunity for you to use? All right. Keep those things in mind. Think about each step of your value chain. Where do you add value most? And ruthlessly outsource anything outside of that core value added function. Okay. There are human resources outsourcing firms you can hire. There are CFOs for hire who can take care of your financial considerations. There are bookkeeping services for hire who can take care of your day-to-day recording of transactions. There are CPAs who can do write-up work for you. That's when they monthly create your financial statements and make sure that they look pretty good and then explain them to you. And that keeps you from having to have an expensive controller position or accounting manager position on your payroll, right? If you can save money doing that outside of the core reason that you add value to things, that is the core of your business, then think about outsourcing them. Do it. Those things you can do without be ruthless. I can't go to that conference this year. I can't spend money on car rentals, or I can't spend money on leasing a new copier this year. All right. Do without things, which you can do for a period of time. After a while, it starts to hurt. It starts to hurt your business responsiveness to your customers, but look at what you could do without on a short-term basis. Finally, as I said before, don't eliminate marketing. Just don't. Okay. Because if you don't find new customers, you won't get through this. Now, in an emergency, right? Decelerate. You start negotiating with vendors in a very serious way. This is my cash flow forecast. We've got a really rough patch coming. I need forbearance for X period of time, at which point I will do Y, whatever, to catch you up. Landlord negotiations. Can I suspend paying rent for a few months in return for spreading it over the rest of the lease? Your key strategy there is a delay and then a catch up later. Bank negotiations the same way. Negotiate with the bank. Will they allow you to pay less or not pay at all and catch up later over the term of the loan, right? Maybe there's a fee for that. Maybe there's something else. But if it makes enough of a difference, do that negotiation and talk to the landlords. Notice how much I say communicate here. You need to have developed your story. To do that, you have to be able to say, I forecasted my cash flow. We do it on a rolling 12-month basis. I'm seeing a decline. I'm seeing an issue. Here's the reason why. Here's what I propose to do, and here's how we'll catch up. Banks and landlords and vendors love people who pay attention to the finances of their business that way, because too many businesses don't. Also, on the incoming side, accelerate. Look for prepaid service contracts. Try to get your customers to prepay you for several months. Offer them a month's free service for prepaying. Prepaid subscriptions. Subscribe to whatever it is they've been buying and do it on a prepaid basis. Ask people to buy gift cards. This is a big deal for restaurants and certain kinds of retailers. If people buy gift cards, you get the cash now. You've got the liability to fulfill that later on. Later on, you're pushing cash out or pushing the responsibility for fulfilling it down the road. Okay. Advance contract payments. If you're the kind of person who does business on contract, ask for an advance payment against your first month's or second month or third month billings. Okay. And finally, look to whatever programs might be out there for disaster or pandemic relief or recession relief loans, or loans that turn into grants like the PPP does, and apply for them. Work with your bookkeeper, work with your accountant, okay? So those are a lot of the things that you do to accelerate your cash in, to decelerate your cash out. Now you have to tell people about it, particularly if you get into the various relief programs administered by the federal, the state, the city. Each of those programs has specific requirements. They have requirements for applying. They have requirements for justifying what you spent those things on. Because if it's a grant and you get to keep the money, the people granting you the money want to make sure it gets spent on what they intended it to get spent on, usually payroll or landlords, okay? Look at each program, look at the specific requirements. What is the program for? What do you get to spend it on? Does that spending correspond with what you need to do in your business? Establish in your bookkeeping program sub-accounts to take care of the tracking of each loan and grant. Where did it come in from? Where did it go out to? You have to be prepared to be audited, and auditors are other people who have no sense of humor whatever. So you have to do that. Beyond bookkeeping, you need these records for yourself. You have to stay up to date on your basic bookkeeping because it's too easy to fall too far behind. You need payroll records for the PPP program. You need leases and utility bills for the other things you can spend PPP money on. EIDL loans, economic injury disaster loans, you can spend on pretty much everything you want to, but the key here is to make sure you have evidence of payments and receipts, whether that's invoices, payroll registers, copies of payroll checks, whatever. The basic original entry document that went into your bookkeeping system needs to be kept around because auditors are going to want to see it at some point. And this is where you work closely with your CPA or your bookkeeper to make sure that you've accounted for each loan or grant or loan to grant program properly, what the specific requirements were, who got the money, what you spend it on, and so forth. Be prepared to be audited. That's very important. Now, there's a number of resources here. I'm not going to go through each one of them. This will be in the copy of slides that you get. I do want to call out Philip Campbell. The book is called Never Run Out of Cash. The website is neverrunoutofcash.com. There's a companion audio CD to it, and that sets forth a detailed approach to taking control of your cash flow. And that has the same template that I used earlier to talk about forecasting cash flow. You're also going to, with your copy of slides, you're also going to get a copy of the Excel spreadsheet for the forecasting as well. Also, specific COVID-19 business resources in New Mexico. You have the health department, the NM Safe certified program, OSHA guidance on preparing workplaces, what you should know about COVID-19 and the ADA. New Mexico's COVID-19 business resources page will give you information about the various state and city grant programs. Albuquerque.gov will give you some resources as to the Albuquerque city programs if you're in the city, if you're within the city limits. All of those things represent resources for you to take another look at. Finally, as I said earlier, nmsbdc.org is the website for the New Mexico SBDC. Their phone numbers are there for you. The email info@nmsbdc.org. I highly recommend that you contact SBDC with further questions or questions that went beyond the scope of this webinar. Similarly, the Small Business Administration, the U.S. Federal Small Business Administration, their website is sba.gov. They are the key affiliate that helps keep score, the association that I'm affiliated with in business. Disaster Customer Service at sba.gov is the email address for the EIDL, Economic Injury Disaster Loan Program, and there's an 800 number there to call as well. I recommend email to contact the SBA. The phone is often tied up. Now, I want to acknowledge Philip Campbell already and his book, Never Run Out of Cash. He was an important source of information to develop this webinar. The National Federation of Independent Businesses, NFIB, has resources on its website for small business cash flow management. Inc. Magazine had the same thing. We used some information from there. And finally, I want to acknowledge the SCORE Association and its Albuquerque chapter in particular, of which I'm a member, for its efforts in partnering with SBDC to develop and present these webinars. Now, Leslie, do we have any other questions from folks?
We do not have any other questions right now, and I know we are running out of time, but I want to remind everyone that when you get the follow-up email, we are not done with Tommy Thompson. We are going to have him again for the next.
No.
I know. You're stuck with us for a while. And the important thing is that he's presented a lot of information. I know that you're probably head is swimming a little bit like mine is, but what you can do is look over the slides that you are going to be receiving, and then come back and revisit with Tommy on the next time he presents and bring those questions in, because this is just the general overview in 1 hour. And sometimes it's most important to look through a specific slide that you had a question on and bring it back to us. Also, we have upcoming webinars. We have 30 plus webinars this month, so take advantage of all our webinar series. I sent you the link. My email address and phone number is on there. If you have questions or want to get in contact with your local center, let me know and I'll be glad to connect you. And that is it for today. We are out of time, and thank you. And thank you, Mr. Thompson. And we will, he's got a last.
One last comment. First of all, I want to thank everybody for your attendance today. I also want to talk about what's next. What's next for you? Go back to your business. Sit down and develop a cash flow forecast. Use the Excel spreadsheet template that Leslie's going to send you along with the slide copy. Develop that forecast, use that forecast. If you don't like what you see, start using the techniques in order to better improve your cash flow coming and going. So do it now, do it today, use the information from here while it's still fresh in your mind, figure out, go do it, and then come back with questions about what happened. Did it track the way you thought it would, or didn't it? Why didn't it? And ask those questions in the next seminar and find out answers. We'll try and address them as best we can and get back to you offline if you've got a specific fact question that we don't have the answer for at the moment. So we want to thank you very much for attending today. SBDC.org, nmsbdc.org. You're going to get a small survey via email after this presentation. If you liked what you saw, I'm Tommy Thompson from the SCORE Association. If you didn't like what you saw, I'm Mortimer Snerd. Thanks very much again, and that's it for today.
Thanks, everybody. We'll see you next time. Bye.